Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the first meeting of the Reserve Bank's Monetary Policy Committee for the first time in 3 months, first time in 2022 as well. An increase to the official cash rate of 25 basis points, a bit of a change to the LSAP, the Large Scale Asset Purchase Program as well, but not really on the monetary policy side, but also an upgraded expectation from the Reserve Bank about inflation. It's already at 5.9%. Where to next when it comes to prices?
Yeah, so the Reserve Bank picking inflation will go to 6.6% in the current quarter, so that's higher than it was previously. But what is interesting is you look at our future quarters, Reserve Bank's still expecting inflation to then ease pretty much at the same rate as they had been picking previously. So still very much the sort of sentiment behind those forecasts would suggest that they're expecting most of what we're seeing in inflation to be temporary or transitory or one-offs, however you want to phrase it. It's quite interesting though, I've been around talking to several clients through the course of this week, and the businesses, they're saying, look, there's a heck of a lot more price pressures coming through yet. I talk to a lot of people in construction, so it's not necessarily right across the economy. But yeah, there's more to come through. We look at diesel prices pushing up over $2 a litre. I don't think that's been factored into the price of goods and services that you and I are paying at the shops yet. International shipping costs are still high. We've got a labour market ever tighter, of course, with the unemployment rate at 3.2%. And wage inflation is accelerating, but I think there's still a lot more pressure to come through there as businesses are just screaming out for staff, really struggling to both retain staff and find new workers as well. And that's only exacerbated by the Omicron outbreak and the effect that potentially has on absenteeism as well. So there's a lot of price pressures, and I'm increasingly concerned actually that this is turning into something that's not temporary, but where these price pressures, maybe not at 6 or 7% per annum, but they will be sustained outside the top of the Reserve Bank's target band for longer than certainly the Reserve Bank is thinking, and even that we were forecasting as well.
Yeah, absolutely. And I think, looking forward from what we're hearing from other clients as well, on the ground myself, hearing the same sort of sentiment that prices are going up. People are looking to raise prices more frequently, looking to raise ahead of the curve because they don't want to be stuck behind, with all of their supplier costs coming forward as well. And there is certainly a feeling that the Reserve Bank has lost control of inflation. It's 3 times odd what their midpoint target is. And the feeling as well is that, look, inflation is not taking a slow or cautious or considered approach. It's going hell for leather. And the expectation, I think, from a lot of people out there is that why isn't there more urgency from the Reserve Bank? And it was interesting to see the reaction from a number of commentators, but also the statement from the bank itself. We saw a clear focus from the bank that they will get inflation back to 2%. That's their phrasing, but also the view from a lot of commentators that the statement was quite hawkish. There was a huge expectation for not only further rises, but certainly the potential now, a real live potential for a larger increase. In our minds, it's almost a little bit too little too late. It's sort of the time for big increases has passed. I mean, we certainly still support a 50 basis point, but the Reserve Bank does seem to have moved too slowly and therefore has to raise more later because they didn't reduce that stimulus earlier. In fact, going forward, remember in November, the Reserve Bank was expecting a peak OCR to sort of float up to about 2.6% odd. Now that's 3.4. So there's been quite a large increase in what the Reserve Bank has been picking for the official cash rate moving forward. That is going to start to put a lot more pressure on interest rates as we move forward. But certainly, as we sort of look at that track and that path forward for the official cash rate, there is a big question over why would you not go faster? When you're trying to heat an oven up, you don't sort of do it in smaller increments. You try and whack it up as fast as possible to the place you expect you need it to go to, because you do otherwise run that regret of taking a lot longer and therefore having to do a lot more of the heavy lifting. And so I think as we move forward, the Reserve Bank has come round to that view a bit more, still falling on the 25 basis point view this time round, but a very clear signal that they're more open than certainly 3 months ago to a 50 basis point increase. Looking forward though, Gareth, I mean, you've got already 1-year fixed rates that have moved up considerably. Expectations now are that you'll continue to see that moving forward. Of course, the Reserve Bank also expecting the housing market to soften. That'll presumably limit a bit of household demand because they're going to have to pay much higher mortgage rates. What is the view there over how everything relates there? What is the outlook not only for the housing market, but more importantly for what people are paying when they're looking to refix their mortgage?
Yeah, I mean, that housing market has been showing signs of turning over the last couple of months. We've had house price falls coming through on a month-to-month basis in Auckland and around the rest of the country as well, to a lesser extent. You've seen sales drop away, and certainly the anecdotes about the effect of the Credit Contracting and Consumer Finance Act and the changes there have proved to be true in terms of demand around the housing market as well. Looking forward, higher interest rates are only going to sort of exacerbate the pressure on buyers and their inability to pay top dollar for properties as they may have been able to 6 or 9 months ago when rates were much lower. And so we are expecting much more subdued demand in the housing market through the course of this year. For existing mortgage holders, look, people who've come into the housing market, first-time buyers over the last year or so, who have taken on large mortgages, they will feel the squeeze as you push those 1-year rates up to 4.5%, 5%, possibly over 5%, given these latest Reserve Bank forecasts out into 2023. For everyone else, though, of course, a 5% mortgage rate is just what we were used to prior to the pandemic, and if you've enjoyed paying down your mortgage probably more quickly than you would otherwise have done over the last few years, those people will still be all right. I think the other key for me as well, in general around the housing market at this stage, is that the labour market is so tight. Everyone is going to be keeping their jobs, and so that will limit the number of forced sales that are going to occur as well, because people have the ongoing ability in general to service that mortgage. But the risks are mounting as that sort of peak mortgage rate forecast continues to get pushed higher, with the Reserve Bank having to work harder later through the cycle. And so the irony there is, while they was worried about slowing the economy in the near term, it may well be that the greater action they have to take later could well be more damaging to some of those economic prospects. There are risks at the moment, and we also look at the housing market and see, well, there's risks of house price falls, what we've seen over the last couple of months, being extended for a bit longer. We were pretty sanguine on the house price situation for some time, and we still do think that, particularly in Auckland and Wellington, that the housing market is undersupplied, which would tend to put a floor under prices. But you keep, hammering some of these factors around buyer demand, and it will start to stress parts of the housing market, and house price falls are looking more likely than they were 6 months ago.
Absolutely. And I think, the big one still for me, though, does remain that the Reserve Bank's got a job to do, and that job is to keep inflation under control. They're currently failing in that task, and they will need to be much more aggressive in our minds heading forward to tame that inflationary beast that we have not seen like this for a number of years. We've had a persistently low level of inflation. That is no longer the case, and the Reserve Bank does look likely to have to take much more stringent action to get it under control. The longer they leave it, the worse and further out of control it might well get, and the harder they might have to push against it as we move forward. We'll assess that, where inflation goes, what the Reserve Bank does, and like you said, Gareth, how the housing market evolves continuing throughout the 2022 year, and we'll update everyone on one of our future editions of Econ Talks.